Stanford University.
Hi. So welcome to the third class. I have the pleasure of welcoming Aileen Lee. Aileen. Apologies. I'll do push-ups afterwards.
50 push-ups.
Aileen Lee is the founder of Cowboy Ventures, a digital seed stage focused fund founded in 2012. She's widely admired by many classmates and friends who have worked with her, including Kim Stromberg and Lauren Kalani. She's also heavily involved in the community as she volunteers quite frequently at Bing Preschool, where my oldest son attends. Aileen has many years of experience with startups and in 1999 began her stint at Kleiner Perkins Coalfield & Byers. At Kleiner, she worked with many consumer, enterprise, media, and green tech companies, including Bloom Energy, Blue Nile, Good Technology, One Kings Lane, Plum District, Rent the Runway, Shopkick, and Tell Me. During that time, she was also founding CEO of RMG Networks, the leading digital out-of-home media company backed by Kleiner. Some of the Cowboy venture companies include Dollar Shave Club, Locality, Phil's Coffee, and Chewing Company. She's not only been an investor, but has had operating roles at Gap, The North Face, Odwalla, and started her career at Morgan Stanley. She has degrees from MIT and Harvard Business School. I'm not done. She's also an individual unicorn, given her ability to handle multiple things. A proud mother of 3 kids, also owns a dog, chickens, and bees, and her husband is a Series A CTO co-founder. One last tidbit, there's a lot of great videos somewhat associated with Aileen. One is there's a first round capital Christmas spoof about the unicorns. Highly encourage you to watch it. And then obviously Dollar Shave Club has the best videos. So without further ado, I hand it all over to Aileen.
Thank you. Wow. Tim, oh, that is the most thorough introduction I have ever received. Thank you very much. So this is your time, you guys. I know you guys are really busy and you have a lot of choices of great classes, so I really want to make this useful for you. So maybe I think we're going to do maybe like a little Q&A or something, and so for half an hour we can just chat. So raise your hand if you have questions about anything or how I can be helpful to you. Let's just talk. Anyone? Yes. What's your name?
Henning.
Henning. Nice to meet you.
Nice to meet you. What's on your current horizon?
I'm going to grab this chair and sit down. Is that cool? Current horizon in what way?
What?
I'm gonna go eat dinner later.
Month timeline. Like, what are you working on right now? And what's important to you?
Okay, so my job. So I have 2 jobs. My 80 or 90% job is Cowboy, and then kind of my 10 to 20% job is Kleiner Perkins. And so, because I still, how venture capital works, and you guys may have heard this from David Hornick, but basically, firms usually raise funds. And so a fund is really going to be, let's say, have a life of 10 years. And you make most of the initial investments in the first kind of 2 to 4 years. So you have general partners of those funds. And then, you make your investments. And then, so in my case, for example, I decided to go start Cowboy, but I'm still a general partner of certain funds where I have board seats and stuff. So I'm still kind of do that a little bit. And so kind of in running Cowboy, I think of myself as having kind of 4 or 5 main responsibilities. One is deal flow. Right? It's basically kind of identifying and seeing the best startups every week, every month, every year. 2 is making the right decisions. So you have to see it, but then you actually have to make the right call. Do you pass on Pinterest or do you invest in Pinterest? Do you pass on Turntable or do you do Turntable? It's there's a lot of things that they're tough decisions. So it's you have to see them and then you have to make the right call. The third thing, the way I spend my time is helping portfolio companies. So whether their 12-month horizon is get to a great Series A, or this quarter horizon is iOS developer, designer, press launch. Every portfolio company, we kind of have a homework list for what does the next 12 months look like and what does the next quarter look like, and we're constantly spending time on trying to help them get that stuff done. So that's the third thing. And the fourth thing is probably just running my firm. So our firm is tiny. It's myself and another guy, basically. But the great thing about that is we can basically do anything. We don't really have best practices, and we don't have legacy kind of traditions. We don't have some like FileMaker database that we've been using since 1972 that like some partner refuses to stop using, So we really have the chance to do kind of whatever we want. So like we play with CRM tools, like to just kind of manage our own contact database. We play with building software tools to try and like scrape our own pre-dead pool so we can introduce portfolio companies to companies that might be more ripe for recruiting purposes. Like just a bunch of stuff that like because we're small and nimble, we can kind of invent stuff. And then the fifth bucket is probably kind of trying to market us and build our reputation because we're a startup ourselves and a lot of people don't know who we are. And then also LP relationships. So it's kind of like outbound communication stuff because I have investors and I want to make sure that they're happy. So that's kind of like always in my to-do list are those 5 buckets of activities. And that's my constant horizon. Yes?
Sorry. Maybe we can just back up a little bit, and can you talk a little bit about why you decided to start Cowboy Ventures, how you want to differentiate yourself, like was there a need you saw, and then sort of that thought process?
So I've been really fortunate to have worked at Kleiner for a long time, and it's an amazing place. The people are just outstanding, and I really love it. But I was there for a long time, like basically 14 years. So I kind of felt like my partner Randy Komisar, who some of you may have known or taken a class from, and he's written a couple books, and he's really, really smart. From Kleiner, sometimes big companies will come in, as Kristen knows, like who want to learn about Silicon Valley and stuff. And one of the things, they want to learn about innovation, how to move fast, how to change things. And one of the questions that Randy used to ask them, which I always thought was really a great one, was, what would the new guy do? So, you start in a job, you have a lot of questions, like, why do we have this meeting? Like, why does this memo makes no sense? Or like, why is this organized like this, right? And you ask a bunch of questions. And oftentimes the people who've been there for a long time, they kind of like beat you into submission over time, right? Like, stop asking that question, or you try and change something and like it won't change, so you kind of give up. And after a while, you become one of the people who is trying to stop all the new people from making changes. And I think that a lot of times in jobs, you get at risk of forgetting like all the stuff that you would do if you were the new guy. And so I kind of felt like I wanted the chance to be the new guy again, is one thing. Venture has changed a lot in terms of how much you can get done with $1 million or $2 million. And so I was seeing a lot of companies that were getting quite a bit done, having raised like kind of a more institutional seed round, and then coming to Series A, kind of having traction, having an initial team, and looking for a pretty healthy valuation. And so I felt like, wow, a lot of the stuff that we used to do at Series A, kind of helping put the team together, helping get the product out to market, helping to launch the company, is actually being done at seed now with less capital. I also have some good friends who I've known for a long time, and I think really highly of, like Michael Deering, who teaches here, and Steve Anderson at Baseline Ventures, or Josh Koppelman. Like, they've just done a great job, I think, being hands-on early stage investors. And I heard from them that there were so many seed stage companies, but not that many really hands-on experienced seed stage investors, that there was a lot of room for opportunity to kind of bring more of, I think, what there's a good amount of in traditional venture firms in Series A and Series B, because you've kind of got this established Ivy League in traditional venture firms, but the kind of Ivy League, I don't know if that's a good analogy or not, in seed is still fairly nascent. And so I kind of felt like, spending the next decade and a half doing something smaller and more personal, but like still very hands-on and operationally oriented at seed would be hopefully, and then like the other thing is the math of funds, right? Like when you have a $600 million fund, to return 4x, you have to come up with $2.4 billion worth of returns. Like when you look at the unicorn analysis and like how many of the unicorns and what percentage of them you would have to own to be able to deliver that kind of return, it's challenging. It's not an easy business. It's not easy at seed, but with a $40 million fund, if I could deliver $160 million or $200 million of returns, like that's a great multiple for my investors, but you don't have to actually technically invest in a unicorn to deliver those kinds of results. So like, that's a long answer.
I guess my follow-up question is, are you doing anything differently or unique that, in your perspective? I know you said that you're kind of filling this vacuum of like seed investors, but do you have a unique like thesis or like investment strategy or anything different, or?
I hope that we're unique, but I would say we're a generalist firm. So we're not like only Internet of Things or like, only healthcare education. And we do both consumer and enterprise. We're about 60-40 consumer enterprise. And I think we want to be known as just like, regardless of what kind of company it is, just like great to work with, super connected, really insightful, challenging in terms of like challenging entrepreneurs to think differently or to kind of to give them a different perspective that's hopefully helpful. And then I think also having done traditional venture investing for a long time, I feel like hopefully I have a really good perspective on like, what do you need to do to be able to raise a great Series A and to be able to raise a great Series B? Like, what does the team have to look like? How much do you have to get done to be able to raise a Series A? Like, what's the culture? What are the metrics that are important? Like, what kinds of customers do investors care about and don't care about? Like, because you can't do everything. You can probably get like 3 to 5 things right between your seed and your A. And so hopefully being really helpful and helping them match up like the priorities and the burn rate so that they get there and Series A is like a pleasant experience is something that I hope like we're really well positioned to be able to deliver on, because we've just like I know most of the players at Series A and how they think, and I've just seen a lot of those companies. Yes. What's your name?
Of the, Josh.
Hi, Josh.
Of the people who come and pitch to you, what % do you actually give funding to? And of those that you give funding to or don't give funding to, are there certain spaces recently that stick out?
It's a pretty low percentage. I'm trying to remember, we just did the math, but I don't remember the exact numbers of how many ventures we see a month. We see a lot, like hundreds. And we probably make 1 investment a month. I would say like some of the things that we learned from the unicorn analysis were helpful kind of confirmatory data for our thesis. So, there's kind of this, not myth, but the kind of like some belief that like the best entrepreneurs are all like 22-year-olds, right? And when you look at the unicorn analysis, at least in the rearview mirror, your best shot at backing a unicorn team is actually people who've worked in tech companies before and actually have worked in unicorn companies before. So like I think something like 80-something% plus of the unicorn companies had a unicorn co-founder that had a co-founder that worked on a unicorn before. It could have been Cisco or Intuit, not necessarily like Dropbox or Airbnb, or Google or PayPal, but like these are people who've worked in technology companies before and have seen scale. And they also understand, like, there's something called a product manager, and there's something called a designer, and there's something like, this is how you run an engineering team. Like, they've kind of been in those environments where they kind of understand how organizations should be laid out and what, like, a good marketing person does versus, like, a not good marketing person. And so we do tend to invest in people who have some tech experience. The only thing I'd say from the unicorn analysis is, like, for audience-based companies, like, in the past, and I would guess in the future, too, I think, like, all bets are off in terms of tech experience. Like Snapchat is a good example. And some of the other audience-based businesses, I think you just kind of have to know what you want to build and find someone to build it. And it doesn't seem to take as much technology experience. So that's one thing. Co-founding teams is another. Like as you guys might remember if you've read it, the unicorn analysis showed that like the vast majority of those companies have co-founders. And I think there's probably a bunch of reasons for that. And they're also co-founders who knew each other before. Like they went to school together, they worked together. So they're not like blind dates who met on founder dating, even though I think founder dating is great. It's just like historically, that's like a lower likelihood of, at least on the unicorn list. So I think, because it's hard, right? You want to have people to talk to who are kind of in the same lonely position that you are, kind of running or being a founder. And you want to have complementary skill sets because it's hard to get this stuff done. And so having a technical co-founder or someone who runs the business part of it can be really helpful. What are some of the other things? Like age, we talked about a little bit. Like most of the unicorn founders were in their mid-30s when they founded the companies. So I think it helped us to feel comfortable that like backing people who aren't right out of college and have some experience is actually a good thing. But those are all kind of generalist things. We're not, I often use the example, like, it's not like I think the investors who invested in Twitter had like a checklist, like, oh, I'm looking for like a new novel short messaging service, like, with a, it's like you have to be open for business. You have to let entrepreneurs know that like you're really interested in all kinds of ideas, but most of the best ideas are ones that no one's thought of before, you know, or like, and that most people think are crazy for the first 2 to 3 years. And so I think it also gives me, like doing that unicorn analysis gave me maybe not a renewed sense of patience, but just kind of a recognition, like a lot of these things they're not overnight successes. So if your startup or the one that you've backed is not an overnight success, that does not mean it's not going to be huge. You have to be patient. Like these companies have ups and downs, and hopefully the ups and downs are kind of like on an upward trajectory, but like nobody goes, not nobody, maybe that's not fair, but like they generally don't go and then stay like that forever. Yeah.
So my name is Nir, by the way. You said that you don't necessarily have to have a unicorn to get the returns you need, but I'm assuming you are aiming for one. So 2 questions. One is, what's the process you use, or how do you think about making sure you're not going to miss because there's so few of them?
Yeah.
And then are you more concerned about not seeing one, or seeing them and choosing not to invest?
What do you think I should be more worried about?
I think if you believe in yourself and you think that you're a good investor, it's probably you should be more worried about not seeing something versus letting it go. Although, like you said, things are not created in a day, and you know, so many people told the Airbnb guys that they're crazy, and for so many years they were, you know, in the mud somewhere, not really doing well, and then it suddenly works. So I think it's very hard to tell when it's very early, especially as you're a seed investor.
Yeah.
Not a Series A one. But I want to hear your.
I mean,
your
I worry
thoughts on
about
that.
both. Like, I don't, maybe equally, I don't know. I mean, there's, you know, every investor has the story of like passing on eBay or passing on Twitter or passing on Facebook or passing on Pinterest. I have like all of them. And so you're constantly thinking like, what should I have done differently? What should I learn from that? And it makes me just want to be even more open-minded than ever. You know, it's like, and I think that's what's hard about being, especially a seed stage investor, is a lot of these things you don't know how good the founders are or how interesting the idea is unless you really meet the founders. And that means you have to take a ton of meetings. Like you can't just read an email and be like, oh, that's a shitty idea, or like, you know what I mean? You really have to meet, like I remember when Greylock invested in Facebook and when Excel invested in Facebook, people thought they were crazy. It was 100 pre. This is like, now 100 pre seems kind of like normal. 100 pre at that time was so expensive. Like no private companies really raised money without revenue and without like very significant traction at 100 pre. And, or when Excel invested in Groupon in Chicago, people were like, oh my God, they've lost their minds. You know, that firm is, just going in the toilet. That's so crazy. How can they be so stupid? You know, it's like you have to get on a plane and meet the founders and hear their vision of what they're going to, like what's happening at Groupon, what are the real numbers, what are they doing, and what are their plans before you can really make, like, I think, the judgment. And that's the thing that's really one of the challenges about this job is like I really always feel like, what am I not seeing, or how do I make time to make sure that I'm seeing all these potentially interesting companies, because I want to hear their stories and I want to understand, like, how do they think?
So I'll follow up on that.
Yeah.
And I asked about the process. So if that's the issue and it's a 1 or 2 person firm, what's the mechanism or the process you use to choose who to see? Because you have so little time and so many companies that pitch you, I'm assuming.
I would say it's mostly referral. So it's mostly people who, it could be one of your professors who says like, hey, I really think this team is doing something very interesting. Or, it could be someone who used to work with you, or someone who I've worked with who went to college with you. So it's someone who basically knows you, and it's usually not like another investor who passed on something and said, oh, well, maybe you should talk to these other people. Like, that's not as strong as a referral. And if it's not, but we do take over the transom inbounds, but it's usually the ones that get meetings or callbacks or whatever are people who have some traction. Like, I live in Detroit and I've started this software company and bootstrapped it on my own and I have 20 customers, and here's what they're saying about why they love my product. Like, we'll take that meeting. And the other thing is, I basically have tried to institute this thing where all of my first meetings are half an hour. So I basically try and set up almost like office hours on Tuesdays and Thursdays for like 2 to 4 hours, either not like in a row, but like over the course of time. So instead of seeing 3 companies, I can see 6 companies. And that way we can figure out quickly whether there's a good chemistry and good fit. And then obviously I'd spend a lot more time post first meeting, but it helps me get through that kind of first screen much faster. And hopefully, even if we don't wind up investing, like we give them some kind of feedback that's helpful for them. Yeah. Hi.
Ben.
Hi, Ben.
So my question is, I'm curious, what's the reason you decide to take a job at the VC industry at first place, and what are the reasons like that keep you in the industry for so many years?
Okay. So I always thought venture capital seemed like such an ideal job. You get to work with entrepreneurs, people with ideas and passion who are starting from scratch and are building something and building usually products that customers love. So it's kind of like everybody's a challenger, and like you're kind of building these challenger companies. It's so exciting. I used to, like when I was in high school, I used to like read Inc. magazine. It's kind of like, I just was really interested in like the process of building new businesses. But I have to admit, so I worked as an analyst at Morgan Stanley after college, and a lot of people in these analyst programs do like a third year. And when I was thinking about what the options are for third year, I had heard like venture capital, that there were these firms that backed startups, but a lot of my classmates were looking for VC jobs, and they were like usually two types. They were all guys, and there were the guys who kind of like went to prep school and like probably lived in like Danbury, Connecticut, and like their dads like were venture capitalists, or you know what I mean? Like they had kind of grown up in business, and their dad's friends were all in business, and and maybe they were like athletes and stuff, and then there were other people who kind of were just like super intense, like Wharton undergrad, like bow tie to school, like briefcase, like reading the Wall Street Journal in high school kind of guys, and like super intense. And I was neither of those flavors, and I just figured like if those are the people who go to VC firms, I will never fit in. And so I didn't even apply. I don't think I probably wouldn't have gotten a job if I had applied, but I just figured I would never fit in. And then it turns out venture capital is a lot different than that, actually. Obviously, it is mostly men, but especially in Silicon Valley, it's not so much a country club kind of a situation, I don't think. And I got really lucky also to go to Kleiner, because Kleiner was probably like, I think there are some firms that are definitely like more macho, where the guys do play golf together a lot or basketball together and stuff like that. I mean, working with people like Vinod Khosla and John Doerr, like if we had to play basketball, I would probably take them down. It was much more of like a family environment, where it was about the ideas and the entrepreneurship and being like a good citizen outside of work and doing things for the community, not just the work stuff. And so I got really lucky going there, because when I wasn't really even thinking I would fit in venture capital, or that I would do it for much more than 2 or 3 years. I had been working at Gap, helping to kind of build our e-commerce business in '99, and as you guys may have read about, it was like the dot-com boom at that time, and a lot of the firms were staffed by people who had kind of grown up in networking gear or semiconductors or enterprise software. There just weren't many consumer people in the venture firms, and really nobody knew anything about e-commerce. And so I wound up getting an offer to go to Kleiner, which I thought would be like a 2 to 3 year job for me to learn about startups, and then I would be able to go to a better startup than I would have otherwise. And I wound up loving the work, and I think it turned out to be an okay fit for me. So that's why I've stayed in it for a long time. Yes. Or do you haven't asked a question yet?
Sure. I had a question about your shift from Series A to seed, like you mentioned earlier. I don't know if I have to repeat that, but you mentioned that, like the stuff has changed over time in terms of team formation, and people already have traction at Series A. Maybe you could talk a little bit more about like your shift, how you changed from Series A to seed, and what you saw the differences were from the startup side, and also like over time, like you mentioned those.
Yeah, you guys ask really good questions, by the way. So seed, I'd say one of the 2 surprises among others. One is, by definition, the companies at seed are more raw than when you see them at Series A. They're like, sometimes the entrepreneurs aren't as good at storytelling. They're not as confident. They don't have like the numbers at the tip of their tongue. Like by the time they get to Series A or Series B, it's like their pitch is tight, but it's not as tight at seed. And I don't think they really understand, as usually if it's their first startup, how to interact with investors, and like kind of what words to use or what words not to use, and like what numbers are important, stuff like that. So that's one of the things I do at like with our companies, it's kind of hopefully help them get more used to that. And so when they go raise their Series A, and then they have like a board, and they've got 8 or 10 million bucks in the bank, like they're ready for it, and they know how to run a board meeting, and they know kind of how to communicate with their investors. And the other thing that is kind of been nice and fun is when you are a Series A or B investor, assuming it's going to take 8 or 10 years for this company to see an exit, you're you're married for 8 or 10 years. Like you're on that. Like when you guys, if you're going to raise money for your startups, like especially for your Series A, you really need to get to know your options and the person that you're going to be working with on your board and how they work in good times and bad times, because it's really hard to get people off your board, and they will be on your board for 8 years. And you're not going to have a lot of board members. You're probably going to have 2 or 3 investor board members in the life of your company. And so it really is a marriage. And so when you make a commitment in as a traditional venture investor, you really are going to be together for a long time. It's not that we're not with our seed companies, but the way we think about it is like we hopefully help them a ton in the first 12 to 18 months, and then we help them raise a Series A, and then they kind of graduate and go to college. And they can kind of come home and do their laundry with us, and like they can always call 24 hours a day and talk through something that's tough or preview something before they talk to their board, because we were kind of with them in the most raw early stage. But my kind of the graduation rate at Seed is interesting for me, because it's basically like I kind of have a new crop of companies every 12 months. And I still help the other folks, and sometimes I observe on the board and stuff like that, and I sit down with them when they're thinking about raising their next rounds of funding and stuff like that. But it's a different rhythm. It's been fun. I really like that. Yes.
Okay. So raising a fund is somewhat of a black box to me. Whenever you talk to startups, they just say, "Oh, we're going to go to Sandhill," and they have all this money. But can you sort of shed some light on that? What's the process? Or
right. So are you talking about seed or Series A or?
Seed.
Okay, seed. So I mean, it's pretty similar. So what I would figure out is, what's your game plan for the next 18 to 24 months, and how much money do you think you need to do that? And ideally, you get some kind of traction, you build an MVP, you talk to some customers, like you basically have something to show that it's not just an idea on slides. And then I would make a Google Doc basically with a list of target seed investors, and I would do a bunch of research online about what are names that you've heard, go to their website, see if they've invested in any competitors, see what kinds of companies the different partners have invested in, and kind of make a list of firms that could be a fit and specific partners. And then I would show that to a couple friends who've raised money. And I would ask them to add names or to give you kind of constructive criticism on experiences they've had with different people. And then you kind of tier it. Here's my A bucket of people who I think are a perfect fit for me. And ideally you have 8 or 10 people in that bucket. And then maybe you have kind of a B list of people who you think aren't as perfect, or maybe wouldn't be as psyched if you got them. Mm-hmm. And then I would work on my pitch. I would show it to friends who had raised money, or maybe even a friendly investor who's not a fit but is a friend and wants to help you out, so that you're that the pitch kind of works and you know what you're going to say in the meeting. And then I actually would probably I would try and get introductions instead of cold calling, and I would probably do my first meeting or two with people on my B list. It's kind of like you're off Broadway, so that when you meet your first people, you have more confidence and you kind of know how it's going to go. And you're ready for them to take it fast if they're really interested, because you've already met with other people. You know what kind of questions they're going to ask. You know where your head is in terms of am I ready to take the money if they offer it to me? And that's pretty much the process I would follow for every round. Except for the difference is sometimes you'll probably get inbound. Let's say if you raise seed for a bunch of our portfolio companies right now, they're both at some one A that we did. She hasn't even launched yet. She's getting a lot of Series B interest, and so a series a seed that just closed in November. We have another 18 months of runway, but they're getting a lot of inbound for A, and so the entrepreneur's should I take these meetings? Should I not take the meetings? Because sometimes, in a way, time is your enemy. If someone's been seeing you over the course of 12 months and you're so raw, when it's time for you to raise the money, they'll kind of remember how ugly the duckling was before, and it won't look as pretty. Whereas if like just meet you and then they see what like a pretty duckling you are, like they're in. So you kind of have to balance the getting to know people along the way and having them feel like they've been getting to know you and they've been watching your progress and they continue to be impressed with how things are going, and you're really comfortable with them, because again, it is a marriage, especially at Series A, versus like wanting them to kind of like meet you quickly, fall in love, and commit. And so there's just a constant tension there that you want to navigate. Yes.
Thanks. So you mentioned that you should look at like if an investor has invested in a competitor. I'm wondering, would an investor be more likely to invest in you if they've already invested in a competitor? Basically, do you pick like the horse that you want to win the race, or you invest in a market?
It depends on what the firm is and like what their philosophy is or what their stated philosophy is. So certain firms, especially if they're more small check, broad diversity portfolio funds, they may invest in multiple people in a space. Like they might try and invest in Uber and Lyft and Zimride and Sidecar. But for like an anchor investor who's really like on your team, they're your pit crew, they have access to all your numbers, you don't want them to be investors in a competitor's, even if it's someone else, like another partner at the firm. It's just like recruiting, right? Like let's say if you need an awesome VP of engineering and they have one recruiting partner at the firm, who are they going to introduce it to, you or your competitor? Just all that kind of stuff. And also like if they're ever beating you at something, then you don't want the firm to be like, oh, this one sucks, we all like this one. You really just want them to be thinking all the time about like, how do I make you super successful? So yes, at least most traditional VC firms are going to place one bet in a space, and that's probably how you would want. I think you would want it. Yes.
So I kind of just wanted to push a little bit on my original question. So I'm just still curious, like, why did you call your firm Cowboy Ventures? It sounds like you want to do something against the grain or something different. But then you also said that you're kind of keeping it traditional. And then, so related to that question, I'd love to get your perspective on what your thoughts on other VCs are doing, such as, like Andreessen doing the agency model, or like 500 with spray and pray. Like, I feel like if you are a new firm, you just launch, like, you probably want to do something to differentiate yourself so the entrepreneur is attracted or like shows the value add. So I'm just kind of curious along those lines.
I think it's a really good question. And I mean, I think and I hope that the way that we're differentiated is partially from references, right? So like my goal is with every investment that we make, that those entrepreneurs, and not in a competitive way, like we want to beat the other people, but like we want them to tell their friends, like Cowboy Ventures was the most helpful investor I had. They helped me recruit this person. They gave me this idea. They warned me about this thing that was totally awesome. They introduced me to my first 5 customers. Like they're super connected. There was like not a single person that they couldn't get me to like in a single email. I think we're pretty differentiated on that, and it's very much like we're not. Andreessen Horowitz I think is doing amazing things. Like they've really disrupted and shaken up a lot of like things that had not changed for a long time. I think they've done a great job, but that's a fun. Like you have to have a lot of fee income to be able to deliver those kinds of services. Like that's not my model. Like I have a $40 million fund. So like my model is personal attention, like hands-on help. So you kind of have to like me and Noah, my business partner, and what our entrepreneurs say that we've done for them, because that's really like, like you're not going to get all the services. That's what our job is to help you get to that round and to be able to graduate to the firms that have a lot more resources than we have. But I think at our stage, hopefully we are among the best of people who could help you at the stage that we're at. And Cowboy, it's funny, like I actually didn't think it was going to be called Cowboy. So Cowboy was like the placeholder name. So I have 3 children, and I have twin daughters who, at the time that I got pregnant with our son, were I think 3.5 maybe, and they, we wanted to include them in the process, right? Because like we had been, like it had been only their world for a long time, and then we were introducing this little new person coming along, and so we told them we wanted them to help us think of the name. And they were 3.5, so we figured they'd forget, like they forgot everything else. And then like a couple days later, they did this dance around the kitchen, and they were so excited. And I was like, "What is going on?" And they were like, "Oh, we told our teachers we're having a baby brother, and his name is going to be Cowboy, Handsome, Shiny Dolphin." And we were like, "Oh my gosh, okay." And so I was pregnant at the time. I still had like 3 or 4 more months to go. So we called the baby Cowboy Handsome. Like, you know, if I don't know if how many of you have kids, but like you oftentimes have like a code name for your baby. And so our baby's code name was Cowboy Handsome. And then we got to the hospital, and the nurses were like, "What's your baby's name?" And my husband and I were like, "Cowboy Handsome." Like we just hadn't, like he's an entrepreneur, I was working a lot, we hadn't thought of names. And we had gotten really used to Cowboy. And I think it kind of captured what we were looking for, which is like, we wanted something that was like fun and different and confident, but kind of playful. And so that's not his middle name is Cowboy. It's not his first name. So we didn't go all the way on that one. But so kind of when I was starting the fund, I mean, you're fundraising for 3 to 12 months when you're starting a new fund. And so it seemed silly to spend a lot of time on naming when I didn't even know if I had a fund. And so I kind of called it the Cowboy Fund when I was fundraising, and I thought I would change it later. And then I had like all these dinners and sessions with my friends who are professional namers, or friends who are entrepreneurs, or friends who are like creatives, and we brainstormed, and like lots of wine, and like I bought like 50 URLs. Like I have so many names if any of you wants an extra name. But at the end of the day, entrepreneurs are like, they basically told me that they love the name, because I guess what I'm trying to do with Cowboy is, you know, a lot of the other firms have very like important names, like, you know, Elevation or Scale or Sequoia or, you know, Benchmark. They're like very solid, sturdy names that will be here for posterity. You know, and like what Cowboy is we are different. Like we're small, we're very nimble, we're personal, we have a personality. Like we have fun, we're goofy, like we get to know you, we get to know your family, and like we're part of your family. So like that's like kind of all the things that I wanted in the name, which was like not kind of like we're like the Harvard Library, but you know, like that, like we kind of think differently and we're fun to work with, and like the spirit of the West. Like apparently I'm from New Jersey and I worked at the mall my whole life, so I'm not exactly like, I have to learn through word of mouth about what Cowboys are really like. But like people from Texas and stuff have said to me like, Cowboys are, you know, like they can figure out anything on nothing. You know, they can fix anything. Like they're totally all about trust. Like they can look you in the eye and like, you know that you're like, they trust you, and like they don't have to talk a lot, but they understand. And like all these, I was like, oh, those are all good things. So that's why we stuck with Cowboy. That's the long answer. Sorry. Yes.
Hi, I just wanted to see if you might be able to give some perspective on the current like balance of power between entrepreneurs and venture capitalists in general, and then related to that, I think like Bill Gurley had a blog post this morning in the Wall Street Journal. They talked about how oscillations in the open sort of capital markets, NASDAQ, has a really, really quick effect on the fundraising environment all the way down to the sea level.
Yeah.
I'm just wondering if you've been seeing that over the last month, and sort of do you have any other thoughts on that?
So I haven't seen it in the last month, but I do think that the public markets are like the tail that wags the venture capital dog. It's really funny because it doesn't make any sense, right? Like when networking gear startups or stocks are really hot, investors tend to invest in networking gear, even though there's like an 8-year kind of cycle that like, that, you know what I mean? That it just doesn't make sense. But I think it's just a psychology thing. But I don't know. I think even, you know, tech, like cloud stocks and stuff like that, what's going on right now. And then also, obviously, there's a lot of weird geopolitical risk right now that could screw up a lot of things. But I do think also just the cycle of innovation we're in right now is so amazing, right? In terms of like wearables, right? And how that's really transforming, I think, the digital lifestyle, or software for businesses. Like so many businesses never really got B2B 1.0. You know, like they still use clipboards and Excel spreadsheets or FileMaker databases, and you know, or like they're you know, they have these rote processes that have no transparency, no data to them, no efficiency. Marketplaces, yield management on existing assets. Like there's so many cool things that are happening that actually make the world more efficient, more delightful, give people more access to stuff. I think even if stocks are not in tech stocks in particular aren't doing well for a while, or if there's geopolitical risk. I feel like this wave right now is very, very strong and may be pretty difficult to dampen. So.
And then the first part was just
Yeah.
balance power between
Oh,
entrepreneurship.
I mean, I think it's hopefully very clear to you guys that it's very much an entrepreneur's market, and that's good. I mean, that's why so much cool stuff is happening. I think it's very much. I don't know if any of you would feel differently. That the balance of power is more on the investor side than the entrepreneur side. I mean, if you think about it, a startup that basically has not much revenue, if any, and maybe 20,000 customers, like visitors or something, and has been around for 9 months, can raise money at a $15 million valuation. Like, have they built $15 million worth of value? Like in, most cases, not really, but that's what's going on right now in the market. Like ideas are worth $10 million. So I think that it's really exciting for entrepreneurs because it's like, you get diluted much less and fundraising is much easier. But obviously the downside or the risk of raising money at these high valuations is you have to grow into them with the capital that you raise. So make sure that you're raising enough so that it's going to give you enough runway that if you wind up raising at 10 pre, 12 post, you and your team are only going to feel good if you raise your Series A at 20 pre. And so what do you need to get done with that $2 million to make sure you can raise money from someone good at 20 pre? Yeah, go ahead, Tom.
What do you think about crowdfunding and kind of the new laws that are being passed where non-accredited investors can invest in private companies? Do you think it's a good thing or a bad thing? And do you think it's going to affect kind of the financing rounds that you're doing?
So I'm not an expert. I haven't studied the law changes very closely, but I feel like, I think AngelList is pretty amazing and kind of the whole concept, and also just you can kind of see where things are heading there. I just think it's fascinating, and it's really innovative. I think for a long time, individuals have been able to invest in fruit farms, and doctors and dentists have been organized by fundraisers to invest in Ecuadorian wineries. I don't see why they shouldn't be able to invest in startups. But I don't think that that's a replacement for helping a startup. I think if I was a startup entrepreneur, I would still want kind of anchor investors who are experienced in helping grow companies. It's not, so I think they're different things, But I also think it's great for filling out rounds. I won't be surprised if there are some unicorn stories, just like, eBay is famous for having called on every VC firm on Sand Hill Road, and pretty much everyone passed on it, because they thought Beanie Babies and staplers, why is that interesting, and Pinterest too. A lot of people passed on Pinterest for the Series A, and so I'm sure that there will be some unicorn companies that are basically built on crowd-funded platforms that no traditional investors wanted to invest in, and it will give them even more credibility.
Do you how would you think about investing in a company that's raised money from a crowd? Would that be a positive signal?
Yeah, it could be, especially if it's hardware. There's a good number of, Oculus Rift is a good example, right? Yeah.
And what, more generally, as you, in seed rounds, is there a concept of one investor leading the round and other people filling in? And how do you think about the other investors that you're working with?
So right now, the way we usually do it is we're partnering with First Round Capital and Softtech, or Baseline and Harrison Metal, or Forerunner, or Homebrew, and or Floodgate. And so we're kind of the anchor investors, and then they fill in sometimes with SV Angel or Google Ventures or AH or individuals. They kind of make a list of what's the expertise that we want, or the scar tissue, or the domain expertise that we want to have, and let's go find those individuals. So that seems to work well. I've only been doing this for 2 years as a full-time seed investor, but I feel like the companies who are doing it that way are making lots of progress on schedule. They tend to be on plan. They tend to be pretty articulate about what their milestones are and what their priorities are and what they're not going to do. And they tend to be ready for a Series A, and they can run a board meeting, and they kind of know how to recruit people. It's my experience so far, and again, like maybe I'm a little biased, but like the folks who don't have that and don't want that, they tend to be not as organized.
The investors, the entrepreneurs.
The entrepreneurs who are doing more like the party rounds without any institutional anchors.
2 more questions.
Yeah.
I'm curious to hear your.
Is this okay, by the way? Like, is this these are okay?
I'm curious to hear about your decision to invest in Phil's Coffee, and where do you see that fit into your
Is that a question, really?
Yeah, no espresso. Come on, but seriously, about investing in things that are not exactly technology, and where do you think the line is between what's VC fundable and what is not?
Right. So at Cowboy, we have kind of created what we call a sandbox, which is a small portion of the fund where we can kind of invest in non-traditional stuff. And it's not the same size check that we write for kind of our core investments, but it gives us a little bit more flexibility to be able to do stuff that's maybe not like down the middle. And so Phil's is one of our sandbox investments. But I mean, I think it's a great product and it's a great brand and it's a great management team. And Jacob, the CEO, is really impressive. We have great co-investors there, both individuals and institutionals. But the other thing is, I've been really impressed by how early of a technology adopter they have been. You know, like they basically were very early in adopting free Wi-Fi and like Facebook and using Facebook as a communication channel with customers, Twitter, Fluck, Order Ahead, mobile, like e-commerce. They're very interested in kind of constantly pushing the envelope on digital strategy. And I thought having a relationship with someone like a company like that is really, because we do a lot of stuff that's kind of software for marketers, software for retailers, like all those kinds of things, like having insight from a company like Phil's in terms of how is like a brand that hopefully is going to grow and be nationwide over the next few years, how do they think about technology strategies has been really useful for us. Yes?
So in the unicorn analysis you did, you mentioned that like there was actually no diversity in any of the companies that were part of the unicorn club. So like, what are like the explicit reasons for why you think that no such diversity exists, or why is there no unicorn company founded by a woman?
Well, we're waiting for you. I mean, I think that's a really good question. I think, if you guys are starting companies, I'd be interested in your perspective on, if you don't have diversity on your team, why don't you? I think, obviously that's rearview mirror, so it's companies that were started in the past decade. There are not as many females or African Americans or Hispanics in tech as there are Caucasian males. I have said this like on the record in the past. I think it's definitely harder for women in tech than for men, and I don't think it's right. And so I think there's a lot more, I would like us to do a lot more about it than we are doing. So I'm really hoping that if you guys are going to start companies, you're going to make a commitment to having diversity on your team. You get, there's a ton of studies that show that you get better outcomes that way. It's not like it's just for fun. It's like, it is the right thing to do, but it also delivers better results pretty much on every measure. So, it's something that we can change. But there needs to be commitment. There's just a lot of little things that I think happen between guys or in tech that are subtle, inadvertent things that make women feel less supported or less welcome.
Julie, you had a question?
I had a question.
Yeah.
I was wondering if you could just give us a better idea on the practicalities of the investment in terms of how much a seed round typically is,
Mm-hmm.
if that's typically in a convertible note form.
So in our portfolio, and a lot of investors are different. Like there are some investors who will not invest in notes. They will only invest in equity. We're not one of them. Our seed portfolio is about half notes and equity. Seed rounds the definition has really changed in the past couple years. Like seed rounds can be anywhere from $500K to, I would say, $3 million. I mean, yesterday I was talking to an entrepreneur who said he was doing a seed extension of $5 million after a seed of 5.5. So he could raise a $20 million A. And I was like, wow, you're raising a B right now, and like 20 million is probably a C, but he feels like, from a marketing perspective, like, I don't know. So it's kind of what you want to call it, but I do think like probably I think of like less than 3 is probably seed, and then once you get above like between 3 and 10, and it's your round after your seed, then you probably call it an A. But I would also say, because a lot of people are talking about how some venture firms have become more conservative and they're really traction oriented. They're looking for more momentum and they want to invest in momentum. That means that there may be this A vacuum, or the bar may be higher to raise an A. So that's why there are a bunch of new people raising A funds right now, because they feel like the old-fashioned A of $3 to $5 million has really, as the funds have gotten bigger, those people have kind of migrated to wanting to do later stage, bigger stuff, and that there's this hole. But also, if people are looking for more traction and more evidence that it's working, then more and more companies, I think, are going to raise seed extensions, where they raise like maybe a friends and family of 250K or 500 to build a prototype, and then they raise like an institutional seed of like, let's say 1.5 to 2, and then they raise a seed extension of another 1.5 to 2. So they really have traction when they go into their A. I'm seeing that. I feel like I'm seeing that more and more, and that's okay. It's not like a bad thing if you raise a seed extension. I think you should not feel embarrassed by it if you ever think about doing that. Yes. Hi.
Hi, I'm Sagana.
Hi.
I think with seed, the way I've always seen it is that you require, as venture capitalists in seed, you require a lot more foresight, because you're kind of looking at this diamond in the rough, and as you said, there's so many raw teams that come through. What is something that you personally do, or some good practices from the industry of venture capitalists really trying to understand what the trends are and trying to track them out a lot earlier than everybody else?
That's a really good question. I would be really open to suggestions if you guys have ideas. I have to say a lot of it is referral. So if I think about like our most recent investment, which hasn't been announced and probably won't be for a while, is a security investment, like a security software company, where it's to see, like the referral came from a CEO that I've known for a long time who's an awesome security expert. And he basically said, hey, I'm personally going to invest in this company. Do you want to take a look? And I said, well, I'm not a security expert. Like, I can hopefully learn quickly. And I think there's hopefully other ways that we could help. But I basically just spent a bunch of time with the founder and asked him a bunch of questions. And you just kind of get to know someone, like how much have they thought through? What do they think could go wrong? And how are they planning on mitigating the risk? What's the relevant experience? What kinds of people are they going to be able to recruit to the team? Who have they already recruited from an advisor perspective, from a team perspective? And it was just, and you just get like a good feeling for the chemistry of the person. You're not always right, but like it just, and who else was like, how's the round coming together in terms of like the stuff that we can help with? What are the things that are also needed that other people can help with? And all just kind of came together really nicely. So I don't know if that's helpful or not, but it's not like I had security as like a giant checkbox for what we're looking to invest in.
Thank Aileen for this great Q&A.
Oh, thank you guys.
For more, please visit us at stanford.edu.